Welcome again to our part series for looking at chart patterns, and this is the second video where we're going to look at chart patterns. I think in the previous presentation we looked at support and resistance, and now we're going to move on to look at the actual chart patterns. Right, starting our way, so there are a lot of patterns that you can print on your MT5, your CTrader, or any other chart platform like TradingView, where the market will be moving. As it moves, it makes market structure, it creates structure, and these structures can manifest in the form of patterns. So to start off with, we're going to look at bearish patterns. Bearish patterns basically means that at the end of the day, the price will go down of the previous structure. So the simplest example of market structure is the bearish triangle. The bearish triangle is made by two lines, the support and the resistance lines, and then the price will form a triangular structure in this sense, and then breaks out to the lower side. So in this case, what us as traders will be looking for is opportunities, in most cases, to sell the market in a bearish rectangle. And the typical example has been given below, where price breaks and closes below the support line, and then ends and then continues to go down in a bearish trend. Another pattern which can form, another simpler one, is the descending triangle. For a descending triangle, you'll be having price coming in from the top side and then respecting a support, but it continue making lower highs until it then breaks off again. So in this particular case, you're looking for the first breakout and then a retest, and then continuation on the lower side. So your stop loss can be placed before the 15 before the previous candle, and then your TP can be placed at any points below the descending triangle structure. And then another simpler one and most common one is the head and shoulder. The head and shoulder is a price structure which has got a head and two shoulders. The two shoulders usually line up in the form of a resistance. For example, this is a bearish head and shoulder, and so if we connect these two shoulders, they form a resistance line which is parallel to the support line on the neckline. So the points to look for in order to make a trade are shown below. Again, a break below the neckline resistance line, and then once the break happens, then you look for continuation of price to go on the lower side. We'll look at an example of an head and shoulder when we are going to be looking at chart patterns within a live chart. A rising wedge. This is another bearish pattern where you start off price going bullish, and then you have a reversal again to the lower side. Like the head and shoulder, the rising wedge is a reversal pattern. Unlike the bearish rectangle or the descending triangle, which basically is trend continuation. So for the bearish, for the rising wedge, you draw a trend line on top of the structure, and then another line below the structure. But what's peculiar about these structures is that the top line is not a horizontal line. It's a trending line, as well as the bottom line. And then once you've got a break below the bottom trend line, and then a retest, then you can then have confirmations for prices going low. Again, your stop loss can be placed at that particular position with your take profit on the lower side. And then an inverted flag is another continuation, but what's peculiar about the inverted flag is that the upper trend line and the lower trend lines will be parallel, so that's the only difference between the rising wedge and the inverted triangle. And then you have another break, and then once you have a retest, then of course your TP will be below here, and your stop loss will be somewhere within this range. And then a symmetric triangle, it's almost similar to a inverted flag, but the only difference is that you have a symmetric triangle being formed, and price consolidate until it's trapped within this zone here, and then makes a break. Once it makes a break, then it has got a higher probability of going down on the lower side. So this summarizes the bearish chart patterns. We'll move straight away to the bullish chart patterns. The bullish chart patterns are similar to the bearish chart patterns, but the only difference is that at the end of the day, price will go in the upward direction, in other words, in the bullish side. So again, we've got similarly, when we have a falling, when we're having a rising wedge, now we have got a falling wedge, which is a classic reversal pattern, as well as a inverse head and shoulder. Again, take note of your entries, where you need to place your stop losses, and where price needs to reach up on the upward side. Again, you've got a symmetric triangle, but in this case it breaks above and goes to the upside, and then when it breaks above, it goes up, and then it comes back again, it makes a retest, and then continues to go to the upside. A cup and a handle, this is the less popular one, but of course you've got price consolidating below a horizontal resistance line, and then consolidates before making a breakout. So you've got almost two support lines being formed: the following part of the bottom cup, and then a minor resistance that gets formed, almost similar to what we saw on this previous chart. You've got your first support there, and then you've got another minor support forming on the lower side. And then we have a bullish rectangle, similar to the bearish one. The only difference is that price at the end of the day goes up, and then similarly to the ascending triangle. So I think that summarizes the bullish chart patterns and also the reversal chart patterns. The other most common one, which is part of a special type of chart patterns called reversal pattern charts. These usually indicate that price is about to reverse, and so you need to be on the watch. So starting off with a double top, it goes, and then it creates a higher high, creates a neck, and then goes back again to the same level where it forms a double top. It's also possible for price to even form a triple top, where you'll be having your resistance line on the top and then your support line on the bottom. But you now, instead of having two maximums, you've got 1, 2, and then another third maximum, and then price goes below. And then a double bottom is similar to a double top. The only difference is that it shows that price is failing to go to the lower side, but instead makes a reversal on the upside. And then again, head and shoulders, you've got an inverse head and shoulder, and then there will be your target there. In the head and shoulder, your target will be there, and then your head, and then with your two shoulders, and then that is the leg line. So once the breakout has been made, you'll be looking for potential buys in this case, and then in this case you are looking for potential sales. And then again, the rising wedge and the falling wedge again, typical classical chart patterns. So this brings the end to this particular presentation. We'll continue again in the next presentation, where we're going to look at these charts on a live chart, and then see how we can be able to draw our chart pattern, so that we can know specifically how to enter a trade and when to exit a trade. Thank you and goodbye.